Hello, everyone. Welcome to another panel discussion on an exciting topic on the Ethereum merge. We'll be discussing today a little bit prehistory before the merge and the aftermath, and what happened, what's the future, and what changes for Ethereum. So let's do some housekeeping first. My name is Valentin. I'll be the moderator today. I'm an executive director at the ITSA. I will not be doing an intro because we have a colleague of mine who is part of the discussion. We'll have like around 45 minutes for the discussion, and you can also, as audience, we are live on YouTube. You can ask your questions in the live section on YouTube, and our moderators will forward the questions to the panelists so we can ask them the questions. So before we start, I would like to start with an introduction round with all the panelists today. So I would like to start with Maximilian. The floor is yours. Tell me about you and what you're doing.
Yeah, thank you, Valentin. So my name is Maximilian Bruckner. I am head of sales at 2126 Capital. We're a Swiss-based crypto investment advisor working with institutional investors, private banks, family offices, wealth managers to support them in offering strategies and risk management. We have cutting-edge risk management tooling, and of course, combine that with a knowledge of crypto markets to understand really what is going on all the time and to help them make informed decisions for their clients.
Thank you, Max. I would like to next have Matthias. Hi, Matthias.
Hi, Valentin. Thanks for the invitation. So my name is Matthias Hirtschulz. I'm partner with DeFi, heading the blockchain and digital asset practice. My background is in physics. I did my PhD in theoretical solid state physics, and then went into consulting the first years doing banking projects, let's say close to the capital markets area, and then built up a practice solely focusing on blockchain and digital assets. And we're supporting our clients really from the conceptual design, from a digital asset strategy to the actual implementation of DLT-based infrastructure. So you can think about, for example, the custody, the safe custody of digital assets, compliance solutions for digital assets, or even trading solutions. It goes also beyond, let's say, purely digital assets, but also classical financial instruments, identity, decentralized identity, something like self-sovereign identity. And with that, back to you, Valentin.
Thanks, Matthias. And let's go with Max Schenk. Hi, Max.
Hi, Valentin. Hi, others. Nice being here today. Thank you. I'm Max. I am representing today Blockchain Founders Group. We are a venture capital firm located and based in Germany and Liechtenstein. We are venture capital investors, mainly investing in interesting and impactful crypto ventures throughout the whole world, basically with a strong footprint in German-speaking countries. We, on the other hand, or my role at BFG is mainly in the fields of company building. We have our own incubation program called BFG Superstars, where we combine ideas and high and top-notch entrepreneurs together, and together with them, we would then launch and invest in crypto ventures.
Thank you, Max. Thank you. And last but not least, Christian.
Thank you, Valentin. My name is Christian Fiov. I'm an executive director with ITSA, the International Token Standardization Association. We develop market standards for tokens, like an identifier, a token taxonomy framework, and also a database. And apart from that, our focus is primarily on security tokens and DeFi. So whether it's tokenized equity or debt or any type of LP tokens or liquidity provision, that's basically the things that we are discussing internally on a daily basis. And apart from my position at ITSA, I'm also working for Rudy Capital, which is a market neutral DeFi fund where we basically then also apply some of the knowledge gained from ITSA, let's say, on the provision of liquidity, staking, stablecoin strategies, and so on. And therefore, Ethereum has been and also will be for the future like a playground of ours, and that's why I'm also very interested in being here today for the presentation, for the panel discussion. Thank you, Valentin.
Thank you. Maybe I would like to start with some prehistory to pick up everybody from the audience if they are not like familiar with the topic, to give you some prehistory, and then we'll start the discussion with my first question. Ethereum was like launched in 2015, and ever since Vitalik has been talking about upgrading Ethereum, scaling Ethereum, and especially moving from this proof of work to proof of stake consensus. I remember they even called it at Ethereum the Casper consensus algorithm back then. But after a few years, they formulated consolidated all the updates into these names. And one of these names is the merge, one of the biggest updates in the Ethereum history, also maybe one of the biggest events in crypto for this year. And before we start discussing what's next, maybe let's do an intro and let's do an intro to the merge. What's the merge? What are the technical changes for Ethereum? And maybe you can also mention some misconceptions about this merge, because there are a lot around. So if someone would like to start, maybe with Max, or you can give the ball to somebody else.
I think you'll have to start differentiating between the two Maxes.
But
I'll just pick it up.
I'll always call you Maximilian today. Just for
okay, that works. That works. So I'll pick the ball up. Yeah, I mean, like you said, the merge, one of the biggest technological changes we've seen in really blockchain history, being implemented essentially on the go. I mean, it took a while. Technically, where does the name come from, the merge? Because technically speaking, right, there was a merge or a transfer between two chains running in parallel, one of which was already implementing the proof of stake consensus mechanism, and then there was the old Ethereum chain, which was using proof of work, and these two were merged together, so to say, to adopt proof of stake. And that's essentially the difference, changing from proof of work to proof of stake, more energy efficient consensus mechanism, which also, of course, comes at a cost. I would say the cost is giving up a certain amount of decentralization. It's probably the main point of criticism here, but there are other benefits. So as always, there is a trade-off. I'm sure we'll have plenty of discussion today on whether or not we believe it is the right or wrong path to go forward.
Maybe to add to that, as you were saying, already in the beginning of the history of the Ethereum blockchain, it was planned to once switch to a different consensus mechanism. And that's why also the so-called difficulty bomb was implemented. So it becomes more and more difficult for miners to stay profitable. And then it was actually moved a few times. And the amazing thing to me now was that everything worked so smoothly. Basically, you have that picture in mind that you're running with a car with 200 kilometers an hour on the highway and changing the machine in between. And that's why also it was necessary to have these chains running in parallel, first of all, making sure that the new consensus mechanism is working. And now we have basically two layers working together. One is the formerly known beacon chain, the consensus chain, which is the now called consensus layer and execution layer. And they have now merged. And technically speaking, this also requires then that validators actually run an execution client and a validator client to have a full node running.
Okay, thank you, Matthias. Also, there is this question many are asking, okay, after the merge, after the proof of stake, are we going to see lower transaction costs? And I think this is something that will have to disappoint the people who ask the question, I guess. Do you have something to add to the like transaction fees, the reduction of the transaction fees after the merge?
I mean, I can take it as well. I mean, what blockchains generally sell is block space, and the block space hasn't changed so far. And it means that the price for a transaction is a question of supply and demand, basically the demand for block space and the supply of block space. And that hasn't changed. So it's not expected that there's a major change in transaction fees, actually.
Yeah, this is one of the major. Christian?
No, I just wanted to add that basically, yes, I think this was a big misconception. And that essentially, I think what everybody is looking forward to is basically the sharding, right? Where we would divide the Ethereum network in different shards. So let's say, for example, 5, 6 different ones. And then basically, we would not only have like a single Ethereum network, but in this case, for example, 6, which are interconnected. And basically, this would then basically offer more block space and also basically cheaper transaction fees. And what I think is very interesting also about the merge is basically moving away from proof of work to proof of stake is somewhat also determining like the future of Ethereum, because it all originated from proof of work, where I think it's a very nice consensus mechanism to basically create decentralization. It allowed a lot of people to basically become part of the network, to mine Ethereum. That's why I also think that Ethereum is, next to Bitcoin, probably the most decentralized network out there, because like there's often people saying, yeah, well, there was like 4 or 5 years of like pre-mining, and now basically the show starts. And I think this basically is now probably the right idea to basically first really focus on decentralization, which also guarantees security, and basically now to basically go for more scalability, because this is, I think, always what like ledgers are about.
I think one more point from my side. I think, Christian, I agree very much. The merge was essentially the first step, right, introduced by the Ethereum Foundation. The next steps are coming up, Surge and Verge and all these other future steps. And I think one of them is also the sharding step, right, where really the transaction fees are not and are then being tackled. I think the most important part, which is the switch from proof of work to proof of stake, is also energy consumption savings, right? From the essentially with this major transition, Ethereum has now decreased energy consumption by 99.9%. And I think this is quite a major influence in terms of scalability, institutional adoption, and also maybe retail adoption. So I think we will go into details to that in a second.
Yeah, thanks for the points, folks. I just wanted to touch on one more, maybe. What happens actually to the inflation? Does the Ethereum emission changes? Does the inflation drop? And should it influence the price in the future? People are already talking about ultrasound money, this term developed by the Ethereum community. Can somebody like let us know what's happening with the inflation? Are emissions changing here after the merge? Christian or Maximilian? Yeah.
So, I mean, to my knowledge, or the last time I checked, and I may be slightly off on this, but I believe currently we are seeing deflation due to the burn rate being higher than the supply rate, essentially. So the net outcome is a negative supply change, hence deflation of the token supply. Although, and correct me if I'm wrong, Christian, right? But this is not a certain case. It was expected and it was planned for, but it's not impossible for this to change again.
Mm-hmm. Yeah, that's actually correct, because last year we were taking a very close look at Ethereum, and I think it was last year in September where EIP 1559, so EIP stands for Ethereum Improvement Proposal, was introduced, and it basically had like included the burn of a base fee. And depending on basically the number of transactions that happen on Ethereum, let's say this is now what's valid for like proof of work, so basically not any longer, but back then, basically we had two forces: one inflationary, which was the miners who were basically mining more Ethereum, and we had also the burn of the base fee. And I think on days where there was very, very high activity, we had already like deflation in Ethereum. However, on days where there was less activity, it was still inflationary. And now that we basically have now moved to proof of stake and we have less emissions because proof of work is now gone, I would say like most of the time it should be now deflationary, but I could still picture that on days where activity is very, very, very low, it might still be that we have like inflationary forces which are stronger. Mm-hmm.
Maybe it's also worth noting that due to the different consensus mechanism, the requirement for the inflation or for the minting part reduces drastically, because the miners had to be paid for their energy consumption basically, and to make it actually profitable to mine. And this is gone now. So also in absolute terms, the number of ETH minted has drastically reduced in the order from, I think, around 13,000 to around 1,600 or something like that.
And I think this is also a perfect segue to a follow-up question, because we already mentioned the miners are no longer needed. So we're moving to proof of stake. But what's happening to the miners with all the mining rigs out there who are mining Ethereum? We see that there is some migration to other proof of work chains. We know that Ethereum, actually there is a split. There is Ethereum proof of work, the old version of Ethereum, where people, let's say miners are trying to mine there. We have even Ethereum Classic, which is part of an older split of Ethereum in the past. But I guess these are not profitable that much that for all miners to switch to this and start mining, this would be unprofitable maybe. But the question would be, where do you see the miners going? Are they going to switching to other chains or shutting down their rigs, selling the video cards online? Any suggestions?
I mean, you can look, at least you can look at the hash rates, right? And check what was the hash rate before the merge for Ethereum, and what are, let's say, the combined hash rates of other compatible proof of work chains. And if you look at the Ethereum hash rate, it was something like between 700, 800, 900 in that kind of order of magnitude terahashes per second. And if you look at the hash rate, Ethereum proof of work and Ethereum Classic, it's much, much less. So it seems that there's a small percentage of miners, they might be able to do that profitably, but I guess the rest is just not able to do the mining in a profitable way. And they need to think about selling their assets or do something else with it. But I don't think we can say that, you know, a lot of them have switched just to different networks.
I think it's very difficult to view from the outside, just because we don't know really the economics completely of such a mining company, let's say, right? I mean, for them, it would be a strategic decision, which I would at least assume they would have contemplated for quite some time, because it's not like the merge just came overnight. They all knew this was going to happen. So it's probably a gamble for them, whether they think, okay, we think Ethereum proof of work or Ethereum Classic is going to be profitable, so let's switch there, versus others say, well, this is dead and let's sell our equipment. It would be, of course, interesting to see whether or not there has been more supply of these kind of mining rigs on the market, or whether or not that goes just through private transactions, or if there's another way altogether for them. But as always, and this is maybe another point about the discussion is, is this the right choice to go to proof of stake or not? Who does it benefit? Who does it hurt? At the end of the day, the users will decide and the market will decide. And if we suddenly see an increase in proof of work use, Ethereum proof of work or Ethereum Classic usage, and that would be a very clear sign of what the people wanted. But as long as that doesn't happen, I think it's safe to say that from the market's perspective, the merge was the right decision.
Yeah. Christian, you wanted to add something? No.
Oh, yeah. Yeah, I just wanted to say that it's quite interesting if you look right now at like who was the biggest supplier of mining rigs. It was basically NVIDIA, right? It's basically a graphics card producer, and there was a lot of news recently that NVIDIA totally misplayed those graphics cards, because what's happening right now is that NVIDIA designed dedicated mining rigs for the mining of cryptocurrencies, and they have ordered a lot of chips. And apparently now that also the miners are thinking about selling their graphics cards, we will basically have way too much supply also on the market. And I think most people who were trying to get a graphics card in the past 2 years have noticed it's almost impossible. Like there were like prices like 4 times the original price. There was graphics card for like 2,000-3,000 euros. Yeah, like for me, it was also a super hard time, to basically get one. And I really think that the miners who are currently holding the graphic card, there's not much option of selling. I really think that they will have to look for alternative mining pools. And I think we recently checked also together, and I think Ethereum Classic, the hash rate, I think, tripled within like 1 day, which is an indication that maybe one bigger mining pool was thinking, okay, it might be profitable to just go to Ethereum Classic. However, I could also assume that they are thinking a lot about gains, right? So let's say I'd start to buy Ethereum Classic on the open market, then I triple the hash rate. That's very nice news, basically among the crypto newspapers, and I think many people also see there an opportunity to cash in. Yeah.
But in the end, the miners are supporting the infrastructure, but it needs the blockchain needs to fulfill some use cases, and you need the ecosystem. So I don't think, let's say, these tries of, for example, Ethereum proof of work, so they will be long lasting. And I see that the ecosystem of Ethereum will work on the Ethereum blockchain. And although we all know that there are a lot of competitors also with proof of stake consensus mechanisms and even higher scalability, and the ecosystem hasn't switched to these other chains so far, and that's why all these network effects, they already play an important role, especially in the blockchain space. It's very important because it lives from this kind of Lego approach that you have smart contracts working together, and so this network effect is so important, and I think they will not pick up a lot of traction, and yeah.
I mean, we've seen the dynamic before, right? And I also agree, and we've seen this dynamic before with ETH Classic, right? You mentioned it earlier. So that was a fork of Ethereum that happened when the DAO, so to say, the first decentralized autonomous organization, was hacked, and there was a group of people that decided, well, they wanted to continue on the previous path of ETH Classic versus the Ethereum we know now was essentially a fork. And I think also there it was, I mean, it's pretty clear who won. And what tipped it was essentially the networking effects and the benefits of the new network, right?
And the benefits for the community. All the networks are like built around the community. So we follow the community, we see it state with the proof of stake. So we expect that proof of stake will grow in the future, and we wouldn't be expecting Ethereum proof of work to gain that much in the long run. Yeah.
Maybe one aspect to add to that is, you mentioned in the very beginning that, or someone else mentioned it, that institutional adoption aspect, and especially in that area, it's the energy consumption point is so discussed all the time, and let's say not going away. And I think that's a very good reason also for institutional players that maybe think about looking for a platform where they can issue traditional financial instruments, for example. They will prefer to go on a blockchain that's environmentally more friendly, let's say.
Yeah, we don't have ESG experts on here, but I guess this would be a huge topic in the near future for investors. So maybe this is a question for the round. Do you expect, because of the energy consumption, that maybe Ethereum surpasses Bitcoin in market cap in the near future, just because some people would be scared of investing in Bitcoin with all the energy consumption it has, even though many support proof of work as the most decentralized way to run a cryptocurrency right now. But it's still a huge discussion among community members.
I think to add my 2 cents here, I think it's definitely more attractive now, right? As proof of stake is energy efficient, reduced by 99.9%. We do see that, or we can at least anticipate that from an institutional point of view, Ethereum becomes a quite nice ESG product, right? A product or an investment vehicle where they can generate quite interesting returns while still being ESG friendly. So I think it definitely drives, and we can anticipate that in the future, institutional adoption, but also retail adoption.
Yeah, I can also see why this might be a good point in the future. We actually have questions from the audience, and one of them is very part of the topic we're discussing now. And they're asking, do the ETH miners, the proof of work miners, get any advantages to become ETH validators in the future? This is an interesting question. Maybe Christian, I think this is not.
I could try to answer it like that.
It's not. It's a free market,
like basically,
so it shouldn't be the case. But yeah.
Yeah, correct, Valentin. So basically, no, if you have been miner before, there's no advantage that you basically hold when becoming a validator. I mean, the energy consumption. I mean, it was like a downside that we had to accept because it was basically securing the network. And I think we would all agree that scalability is a very important thing about a network, but I think security always comes first, right? Let's say you're a big institutional making huge investments and suddenly, like with Solana, right, we have a lot of downtime, we have a lot of bugs. I think many institutionals cannot just afford it. You know, this is just something that they also cannot tell to their clients. And so I think proof of work definitely was reasonable for the beginning, but now I think also with like the energy price that we see right now in Europe, also due to the Ukraine war, we should really ask ourselves, like, is it that necessary to basically maintain this big energy consumption? And I would also think, when I think about hardware, I think many people say that, yeah, well, proof of work is more decentralized, and I'm not really seeing it because, like, let's say I would like to be part of proof of stake consensus. I think I can very easily join like Lido or some other liquid staking pools that are available on, for example, Ethereum. I can basically stake there my tokens, and I can do that already with very, very, very low capital. However, if I wanted to mine Ethereum at a very good like rate where it was like very profitable, I would have had to invest like 1,000, 2,000, 3,000. So basically the entry barrier to become part of like the consensus, I think it has basically become easier now, so that more people are basically now able to join the consensus and also be part of it.
Maybe add something on from this institutional side, so to say. I think it will take a while for Ethereum to take over in that regard, even though now it is right energy efficient and in line with ESG requirements that many of them face. I don't think this is a deciding factor for them. in the regard. So to take an example, for example, I'm calling in right now from the there's an event in Frankfurt, the executive summit of DWP Bank, Deutsche Wertpapierservice-Bank, right? And they are launching their Bitcoin product, or offering Bitcoin to their clients starting Christmas or early next year. They hope to have their first trades, right? And they're starting with Bitcoin. They're not even talking about Ethereum yet. And I think as long as Bitcoin remains the first entry for all of these institutions that are joining, they will offer Bitcoin first. I think as long as that remains the case, it will still take quite a while for Ethereum to overtake Bitcoin in market cap, so to say. So in a sense, it's not like that the energy consumption really made a massive difference in that regard to them, except that maybe it makes them generally more open to the concept of crypto assets, knowing that there are options now that are in line with their ESG requirements.
Yeah. Maybe also to add to the question with regards to whether miners have some advantage. I mean, I think that the game and the skills you need for proof of work mining and proof of stake validating are very different. For proof of work, you need to, maintain this large set of mining hardware. It's a game also of scaling, becoming bigger, getting better energy prices, and so on. So there's economies of scale. And on the other hand, if you run a validator, you need to be good in having high uptimes. Otherwise, we will get slashed. So running the nodes in a very stable manner. So I think it's a very different kind of skills that are needed. And I agree with you, Christian, that also, these kind of entry barriers and economies of scale, they are reduced a bit with the considerably reduced with proof of stake.
Yeah, there is for the audience, let's add that if you want to become a validator today for Ethereum, you need 32 ETH for your validator to be part of the validating network. Of course, there are options for people who don't have 32 ETH. For example, mining pools like Lido. It's not a mining pool, it's a pool where they pull together all the assets and then rent hardware in decentralized way. And we have Lido, Rocket Pool. Can somebody tell me, is there benefit? Is this some kind of more centralization around one provider? If you don't have 32 ETH, you go to Lido and you stake your ETH there, and somebody else validates blocks. So because we see that Lido, Coinbase, and Kraken were one of the biggest stakers in the new proof of stake, do you see a danger here for more centralization around staking?
Yeah,
I'll
Max, you.
So I guess in the first moment you would say so, yes, right? I think the two largest ones are Coinbase and Lido at the moment, and then Kraken is coming in third. But once again, as a believer in the coming institutionalization of the space, so really financial institutions entering, and it will be only a matter of time before they enter staking as well. There's currently not really a whole lot of drive from them to use partners like Lido, for example, or maybe they would use Coinbase, but I think a lot of them will set it up themselves. Maybe they will use more infrastructure, like maybe they will use staking providers like Blockdaemon, for example. So I think it'll spread out a little bit more, but to be fair, there will probably be a certain dominance still experienced by a few players, but probably not as big as it is now. That would be my expectation, at least.
And I mean, the attractive thing currently with liquid staking is that actually I can stake my ETH, but still I have this respective rep token. I can also trade and sell if I want to. And in the current environment where we are before the next upgrade and the stakers cannot withdraw their assets. This is a very attractive approach, and with the next, I mean, we don't know when it comes. Maybe it's 6 months, maybe it's 12 months, maybe even later. I just read that, you know, the specific dates were removed from the Ethereum website, so who knows when the next update will come. But when it comes, then also the stakers can start withdrawing their assets, and then maybe we you know, this liquid staking providers that might not be as dominant anymore, and also other crypto exchanges, other providers can come in. And
I think there's also one more risk to keep in mind that we may have missed now. I mean, staked ETH, Lido staked ETH has decoupled from ETH before, right? So we also have, through this liquid staking idea, with all the benefits it gives, it also introduces the risk of decoupling between the prices, right? What ensures that I will be able to swap one to one, or whatever the determined rate should be, versus, you know, typically people fail at canceling out market movements, and that's how decouplings in pricings happen when there's just too much supply or too much demand. Whichever way it is, at some point, as an institution like Lido, you're not able to guarantee a peg anymore. And this is right. I mean, we've seen this happen in the past, even before the merge. So I think this will be another issue that large players will look at very, very closely, if that's a risk they want to take on, or if they want to, you know, set up something themselves or choose another path forward.
I mean, and you would also expect some kind of deduction because you're taking additional risk, right? Because there's a DAO in the middle, there's some governance token, there are smart contracts involved, there are certain number of tech providers running the validator nodes and so on. There, a lot of things can go wrong there. So it's some kind of risk you take when you do that in that way.
Yeah.
What I would like to add is, like, Matthias and Maximilian, I fully agree. I once read on Twitter that essentially we have to see staked Ether as like a forward contract, like from traditional finance, where essentially, you know, there's some interest paid, but still, like, we have some illiquid asset. In this case, it's like the Ether that is staked, and then we basically have the staked Ether on the beacon chain, but also like the staked Ether token by Lido, which is then basically like a trading pair with Ethereum itself. And by that, I have always like the possibility to also leave again the position again, because otherwise my Ether would be like staked, I think, for another 5 or 6 months. I think it's like Shanghai that needs to happen so that you can basically unstake again your Ethereum tokens. But one thing that I wasn't thinking about, and I recently read a very nice tweet, and yeah, sometimes it really makes me think about certain things happening in DeFi. And the tweet basically said something like, well, we had proof of work, and proof of work made Ethereum super decentralized, one of the most decentralized chains in existence. Now we are moving to proof of stake, which is fine for more scalability, because security is there because of the decentralization. However, now we have like this Lido governance token. And this Lido governance token has certain control over the Ethereum that's staked. Like, I think for Lido, it's right now 30 or 35%. And I think taking a look at like the distribution of the Lido tokens among its holders, because I know there was many VCs, there was many big names from the DeFi space. I think Junior Butulup, for example, he's the inventor of the very first Flash loan. He's also managing StakeDAO and other big DeFi protocols. So I think this is always something where most people are not fully aware of it, but in DeFi, you certainly have something that's called governance risk. And governance risk basically describes like the distribution of governance tokens and basically the power that comes with them. And maybe so far we didn't have any kind of situation where like this governance risk was playing out. However, having something so nicely decentralized like Ethereum, then put like in a product where we can see that there's only a few who who basically have a majority is basically, somewhat a contradiction, which I found very interesting to also think about. Yeah.
I think, to also add one last word here, Christian, I think you're speaking about a very valid point. What I also thought about was, now that it's proof of stake and only a few players hold the majority of all ETH staked, having all this, what does it mean to really have power over governance? It means that the ones that stake most get more rewards, right? Potentially, right? Because with proof of stake, it's like a lottery, but the lottery is based on how much ETH you actually stake. So the more ETH you stake, the more lottery tickets you get. And therefore, the probability that you are rewarded more is getting higher. So I think this is something, it sort of reminds a bit on capitalism, right? But again, I want to emphasize here that the merge was the first step. I feel like the merge was mainly focusing on scalability and carbon emissions, and that, this governance topic is hopefully tackled in the future, and we don't essentially know if it's actually being a problem right now and how it's being tackled, right? So I think we still need some time to judge the situation more clearly, but it's definitely something we cannot underestimate.
Thank you, Max. These are all valid points and very interesting ones. We can actually start discussions on each one of them and have a whole panel discussion maybe on them, especially on governance in Ethereum. But we also have a few questions from the audience, and we're running out of time. We have such an interesting discussion. I will try to combine the questions from the audience with what I also have for questions. And one of them is that the question sounds like this: did anyone estimate whether last crashes are more related to macroeconomic factors or to the merge? So basically the question is, what happened to the price and why did it drop after the merge?
I mean, you first, Max.
I think it's very clearly related to macroeconomic factors. That would be my opinion. I mean, it's there are a lot of issues at play currently in the financial markets, right? We're talking about inflation, raising interest prices, raising interest rates, energy prices are rising. There's a war on the borders of Europe. We're talking now about also a threatening currency crisis, so to say, devaluation of the euro against other assets, devaluation of the British pound as well. This is something that happened most recently. At the same time, democratic governments are moving towards kind of a decline as well, in some sense. I mean, we just saw the vote in Italy, essentially a kind of post-fascist party had the majority. So I think there are a lot of things at play that are impacting the world in quite a profound way. And to believe that crypto assets would be unaffected by this would be, in my opinion, fairly naive. In times like these, correlations between crypto assets and any other kind of asset class will rise because we're talking about quite a risky asset here that people would like to withdraw their liquidity from.
I mean, that's the macro analysis, but we have also seen that on the day of the merge, very short time after the merge and the day after, I think we have seen a sharp drop in the price. And it seemed to be really related to the merge. And the question really arises then, what happened there, because actually everything went smooth. And you would expect that before, if you price in some risk of the merge going wrong, you would expect that there's some kind of relief after the merge, and maybe the price moves a little bit up and not strongly down. And the question in the short term, why was this reaction? And I can explain it only in the way that, that it's kind of irrational behavior, and maybe some people disappointed also about the merge, because we have been discussing all these misconceptions, transaction fees fees, transactions throughput, and so on. And maybe some of them just realized, okay, that what they thought will come didn't come, and that could be one explanation. Or maybe the second explanation could be that there was kind of a lot of speculators there that wanted to play with the merge, invested beforehand, and then use the first opportunity after the merge to sell their assets again, something like that.
And maybe one last point from my Christian. Yeah.
There's two quick things I would like to add. So basically, if you look at foreign exchange, right? Like, let's say we have the US dollar, we have the pound, we have many different currencies. And I think we very often do the mistake that we just compare basically, or we just look at prices in US dollar, because what essentially happened was that Ethereum dumped to $1,000. And if you go on CoinMarketCap and you click on the Ethereum chart, you have on the very left always like a little ticker where you can basically add like the Ethereum BTC pair. So how much Ethereum, how much BTC would I get for one Ethereum? And essentially, Ethereum pumped a lot compared to like Bitcoin. I think usually both are correlated to like 90-95%, and the correlation really went down. Basically, once Ethereum hit like 1,000 or let's say $900 approximately, and at the time of the merge, the exchange rate between Ethereum and Bitcoin was the same as back in November when Ethereum was trading at $4,800, I think. So essentially, there was a pump. Like, it's not so visible maybe in USD terms, but more like basically in BTC. Yeah.
Yeah, this and maybe one point from my side. A lot of people are betting on a split, so everybody moved their coins to Ethereum, waiting for a split so they can double their gains, for example. And after the snapshot, you no longer need to hold Ethereum in your wallet. Maybe this is another reason for this. And we have like one complicated question from Arete. Sorry if I don't pronounce your name right. Did Ethereum lose its competitive edge by moving to proof of stake because after the merge, the US SEC hinted at classifying it as security might be a possibility? In the US, they have this Howey test where they test if there's a coin is a security or like a stock. So people are concerned that Ethereum might be easier classified as security after moving to proof of stake. We are not experts on here, but what are like your brief thoughts on that? Like, keep it brief, so we are running out of time.
I think maybe I can start it off. I think the main assumption is that proof of work, you sort of solved puzzles on your own. Therefore, you could argue that you are working for your returns. Whereas proof of stake, now you give your stakes, your assets to somebody else, and they stake it for you, and you get returns. And theoretically, it could classify as an investment security, as an investment contract, and then be sort of need to go under regulation under the SEC. But I feel like it's more going into the direction of that the SEC wants to take Ethereum because it's so big, and they want to challenge it and prevent others to emerge as potential securities. Because I feel like the proof of stake is not new, right? Other blockchains have been practicing it. Why have they not been taken into consideration by the SEC? So I feel like it could go in the direction of making the ETH case as an exemplary case of an SEC case, but essentially we have to see, right? It's going to probably escalate, but we have to see over time what the judgment will be.
And the last question, and we should be ending our discussion right now. It's related to the economy. What's the overall economic effect of the merge to the German economy? I would say for the overall economy, because Ethereum is decentralized. But what are your thoughts? I think we can say that miners are now like losing money because they can't mine. Something in that direction, right? It's not a very specific question, so it's difficult to give a specific answer to that.
Yeah, like I would say that I mean, Germany was never a market for mining, right? I mean, our electricity costs are just too high. I mean, we have like this EEG,
I
I
didn't
don't know,
make
like this. Yeah, right. This
no.
additional, but basically you have like a fixed price for electricity. So I don't think miners that there are too many miners in Germany. What I did, I turned down the heating in December, and I was just mining a little bit, and then basically I was using the heat from the graphics card to heat up my room. However, this is only working for a certain amount of time because it's just too loud. So I think the effects for like Germany are like very minor, or like not even existent. And just like one remark to the question before. They're also trying to go after Ripple, right? And for Ripple, it's a very different case because the validators are basically somewhat permissioned, so they have to be decided also from Ripple Labs. And we don't see anything from the SEC as of like a true like case also against Ripple, which makes, in my eyes, a case against Ethereum even less likely. I think it's very unlikely.
Yeah. Thanks, Christian. Yeah, thanks for mentioning Ripple again. It's ongoing. I think it's ongoing discussion right now about Ripple. So I guess this is the finish line for our discussion today. If you folks have anything to add, like follow us on social media, tell us something about you to do, last words from you guys, and then we can close the discussion. Christian?
Oh yeah, like if you guys are interested in learning more about DeFi or also security tokens, basically ITSA is an association in Berlin. We're non-for-profit, and one of our main objectives is education. So let's say you are really trying to get into the space, or you're maybe already an expert, feel free to contact us. We are always welcoming new members, and yeah, happy to hear from you.
Thanks, Christian. Matthias?
Yeah, so if you're looking to build something on DLT and want to learn about it and discuss approaches, please do not hesitate to contact us.
Thanks, Matthias. Maximilian?
Yeah, thank you. I think no final words towards the topic of the panel, but just in general, feel free to reach out to us if you have any questions regarding, well, actively managed crypto asset investments and the different strategies that are.
And last but not least, Max?
Perfect. Thanks again for the invitation. If anyone is seeing the merge as an opportunity to start a crypto venture, then always feel free to reach out to us if you're already utilizing the merge as an opportunity, as a business case opportunity. Also reach out to us because we invest actively as investors and as company builders.
Okay, thank you, folks. Thank you for being part of the discussion, and I hope to see you again. Bye-bye.
Thank you.
Thank you, Valentin.
Bye-bye.
Bye.
Bye.
Bye.